Welcome to the Real Estate Forum, a podcast from the Paul Milstein Center for Real Estate at Columbia Business School. I'm your host, Raphael Sidelsky. This is your place for key insights into the evolving real estate landscape, from candid conversations with real estate thought leaders, including the esteemed faculty of the MBA Real Estate program, to cutting-edge research from the Milstein Center's Research Lab. Let's dive in. Gregorio Schneider has spent his career at the intersection of global capital and emerging markets, helping shape how investment flows into real economies. He is the founder and chief investment officer of TC Latin American Partners and managing partner and chairman of Industrial Gate, where he focuses on investing in industrial real estate tied to manufacturing, logistics, and the rise of nearshoring across Mexico and Latin America. Over the past 25 years, he's invested across emerging markets through debt, equity, distressed assets, and real estate, developing a deep perspective on how global capital connects with local opportunities. Before launching his own platform, he held senior roles at Oxif Capital Management and the Rohatyn Group. Gregorio also teaches global real estate at Columbia Business School, where he earned his MBA and holds a degree from ITAM in Mexico City. Based in New York with his family, he spends much of his time in the regions where he invests. He's also involved in several non-profit initiatives, including the Qualitas of Life Foundation, which focuses on financial education for the Hispanic community in the tri-state area. Outside of work, he's a marathon runner, an avid hiker, and a certified yoga teacher. Amongst other things, we will be discussing his recent paper, The Southern Border and the Nearshoring Debate, which he published through the Milstein Center. Gregorio, welcome to the show.
Thank you, Raphael.
Before we get into nearshoring, tell us a little bit about your origin story and how you landed up doing what you're doing today.
Sure. So I started my career in Mexico. I was born and raised in Mexico. I was working for a Mexican bank, specifically doing real estate, where when I finished my degree in ITAM, I wrote my thesis and my dissertation on real estate valuation in Mexico. Then I was sponsored to come to Columbia to do my MBA, and I finished just after the Mexican crisis, decided not to go back to the bank, and I went to a French bank in London, where I was focused mainly on distressed sovereign debt. And that's where emerging markets, you can see the growth of emerging markets. I was restructuring sovereign debt, mainly from Latin American countries, buying it from commercial banks in Europe and just going through those restructurings. Moved into the next phase of the emerging markets that was distressed corporate debt. And that was specifically in Argentina in the early 2000s, where I was buying debt from banks and restructuring that corporate debt. And then the next cycle in the early 2000s was growth. So it went from debt, and then you started lending to companies and restructuring their debt. And then it went into the equity because the equity was capturing the real growth. So I went through that cycle in the different firms that you mentioned. And I think the cycle of growth went all the way up, to the 2012, 2013. And at that time, that's where we started our platform and left Oxif together with one of the members of the team, that now my partner, that we've been partners for many years now, Daniel Grunberg. And we decided to start a real estate fund. So we looked at all the asset classes. We had invested in distress, equity, and everything. And we thought, okay, what's going to be the asset class for the next 20 years that we believe is still fragmented, that we could source, we could capture value, and that we were going to institutionalize? Because we had that training. We came from very large firms, very well trained, and we wanted to apply those standards to that asset class. So we raised our first fund for real estate to invest in real estate, mainly in residential for sale in Colombia, Peru, Mexico, and Chile. Just leaving Brazil aside, because I believe Brazil is a complicated market. So you either do the rest or Brazil, but you cannot do both. Well, so we decided just to focus on the Andean region, including Mexico. And then we started investing. We raised money from families, from some institutions in the region, some pension funds in Latin America. And then we went into our second fund, and we realized that we should diversify. And a lot of the themes that we learned in these US firms looking at the US markets like cellular towers and digital infrastructure, that, those asset types were just starting in the US at that time. And then we thought that's going to happen in Latin America at some point. So we started investing in cellular towers, data centers. We developed 2 data centers in Colombia. We're talking 5 years ago. And then we looked at healthcare. So we started to diversifying into many, many asset types in the region. And then in 2019, we got into industrial real estate. And the reason was that in 2019, the USMCA was ratified when Trump was in power. And that shifted completely the perception of risk of Mexico. So we started to see the flow from Asia into Mexico, and very large multinationals establishing their presence there to serve the US market. I'll go more in depth through the interview, but that's exactly why the reason we started this business in Mexico was really just the ratification of the USMCA. Then many things happened that really benefited us, but that's really the catalyst, the first catalyst that made us go into this business.
Let's talk about what nearshoring is. Let's frame that for the audience before we go into too much detail.
I think nearshoring is very simple. In terms of what it is the proximity of the US, is bringing manufacturing and logistics to the closest point of the US. And why is that happening? It's because of labor, proximity, rule of law. So, and I'll go more in depth into that. But think about this. Bringing something from China to the US takes 30 to 45 days. And it's, you need to ship it. It takes maybe 30 to 45 hours taking something from Mexico to the US. So, and nearshoring is not new. Let's be honest. That started with NAFTA. That started in 94. The only thing that is different is the urgency right now. So, at that time, nearshoring was already happening. We started seeing the automotive industry starting to export from Mexico to the US. But it's been very slow. The only thing that really changed was, I think, the urgency right now. We see companies desperate to move their manufacturing, and for many, many reasons. That's the US-China tension. COVID accelerated. So then everyone realized that the disruption of the supply chains was really suffering and more because of the length and the disparity in terms of distance. So when you started bringing it closer, people realized that it was safer. So we had a lot of things in our favor. I think in terms of nearshoring, and the reason it really accelerated was labor. That manufacturing something in Mexico today is 15 to 20% cheaper than China, including shipping and tariffs. The second is definitely, the proximity. I just mentioned, how close it is and how easy it is. And third is the rule of law. The USMCA created a framework in terms of companies feeling more comfortable to manufacture something in Mexico than in China.
That's a great overview. There are these powerful structural forces. So do you see this now as a secular change? And within that secular change, we're going to talk about some of the cyclical, reverberations going on. But why don't we start with tariffs? That's a big topic. Tell us, what the impact of tariffs has been and where we stand today with the tariff situation and Mexico.
I think what tariffs have done is have slowed down what it is a structural change. I believe nearshoring is structural, definitely. That's not going to revert. Look, nothing is going to change the proximity of Mexico to the US. Nothing is going to change that labor is cheaper right now in Mexico than China. Nothing is going to change the framework that we have as the USMCA. I think what the tariffs are doing is just slowing down the decision-making process from companies to establish their manufacturing in Mexico or their logistics. So we had a pipeline. We saw an acceleration that I've never seen in any other market between 2019 and 2023-24. We had growth of maybe 20%. That's crazy in terms of a market that is growing, the absorptions, vacancies of 1% to 2%. A market that constantly has Tijuana had zero vacancy. So markets with zero vacancy, they don't last so long. So what we saw is really real estate is cyclical. Nearshoring is structural. And let's go into your question of tariffs. So what's happening now is tariffs just slow down that acceleration that we were having. And of course, if you put the real estate kind of cycle on top, everyone got so excited that we started to see more and more construction and going from build to suits to spec. So all this speculative development, suddenly when tariffs kick in and you have a slowdown, inventories start to go up. And now we're at vacancies that are around 7%. Do I think we should be in panic? Not at all. I think it's a cycle. Again, nearshoring is structural, real estate is cyclical.
The southern border is not a single uniform story, so let's get into some of the key markets. Juarez, Monterrey, and Tijuana all differ. Tell us about the different markets and tell us about the type of industrial that has been built and should be built in those markets.
I think let's start with Mexico. So Mexico has 650 to 700 million square feet of GLA. And let's compare it to China for a second. China has 22 billion. So all the Mexican market today is Detroit. Same size as Detroit. So, it's a super small market. So when I'm telling you how important nearshoring is, it's very, very early. What we're seeing is we don't even have, if we get 3% of the Chinese market, we double the size of the Mexican market. So, it's very early. So then we can go deeper into the specific markets. Tijuana, completely integrated into California. And it's a, manufacturing, industrial, but really integrated into the economy of California that is, of course, is one of the most important in the US. Then you have Juarez. Juarez is also a manufacturing market, more related to the auto industry. The problem you're having with Juarez is more infrastructure. Juarez has infrastructure challenges based on energy. So a lot of the energy and utilities has not been developed. So that market is going to have constraints in growing. And that's why we're seeing that all the spec development, a lot of spec development that was done in Juarez doesn't have power. So a lot of the vacancy has a lot of noise because no one will take any property that doesn't have power. So that vacancy is not real. It's more related to challenges for properties to be delivered to any tenant. Monterrey, I think one of the strongest markets, one of the markets that has the more depth. Also, I would say vacancies are around 5% right now. So it's healthy, but because of those markets, people continue to develop, and now that excess inventory and that excess supply will need to be absorbed once we get clarity from tariffs. Finally, I think the other market that is important is Mexico City. People don't talk so much about Mexico City. That's a logistics market, but it's extremely important. A lot of the production is done there and just sent to the north. That's the lowest vacancy right now in the country. So we're still at 1% to 2% in Mexico City. And Raphael, we didn't talk about currency, but all these markets are dollar markets. The lease agreements are just, the same as a lease agreement in the US. We have properties in Tijuana that we have a guarantee from multinationals. So, we have properties that it's a US market domiciled in Mexico, if you want to think about it that way.
Well, you have a great line in your paper that this may be less a sign of failure and more success being digested. And I would say that a 7% vacancy rate is actually, that's a pretty good success rate in general. When you're coming from 1%, it looks worse. But are we at a point where vacancies have sort of peaked? Or do you think vacancy is going to increase before it starts to tighten?
I don't think it's going to increase. I think we're getting to the peak of the vacancy because it's been maybe a year or 2 years that we continue to see properties being developed on the spec side. But no one continues developing spec right now in markets where you have vacancies of 7%. I think the challenge right now is going to be just to get infrastructure in place. A lot of these cities need to have the infrastructure. But, I think the story is a story of different markets. You have more labor and sophisticated labor in Tijuana. and Monterrey than maybe you had in Juarez. Or also the industries. The auto industry is suffering more than other industries. So we're going to start to see those markets. I think a lot of people invested in Mexico thinking on the theme, the nearshoring theme. And yeah, that sounds sexy, but it's really a local strategy. You need to go market by market. You need to analyze it. You need to analyze it like you analyze any single investment. And you need to think, is this city capable to deliver properties? And is the demand going to be there? And that's where you need to go deeper. And that's the background that we have in emerging markets, right? Like, this is a local strategy. It's not a macro strategy, even though the macro theme is super strong. But the way you execute it, you need to execute it as a local strategy. So,
well, your paper references a new wave of secondary markets that maybe have more infrastructure in some cases or power. Tell us about the secondary market wave.
Look, I think the Bajío market is interesting. That's where Querétaro is. A lot of the aerospace industry is establishing there. A lot of what happens in these markets is that one large multinational comes in and then an ecosystem starts to develop. Puebla, it's a good example. Puebla is where the Volkswagen plant or the Audi plant is. All the ecosystem develop around it. So the same is happening, in Querétaro, that you have Boeing. The moment Boeing establishes itself, then the ecosystem develops, and a lot of the growth can happen because the infrastructure is in place. So you have labor, you have infrastructure, and you have the corridors. Also, you need to make sure that you have the corridors to go to the US, because that's the market we're serving. That's the beauty of this strategy. Everything is focused on the US. It's not a it's not a Mexican consumption play. So when investors ask me, so how is Mexico doing? Honestly, in this strategy is irrelevant. If Mexico grows 1% or 2%, it doesn't make a difference. Because what we're serving is the US market. What I need to focus on is what's happening with the growth in the US. But again, I think I want to emphasize one point, Raphael, is we're expressing a kind of like, we talk macro and micro at the same time, all the time in this strategy. We need to really look top down, bottom up. And this strategy it is an expression of a macro theme. But the execution needs to be local. So, you cannot execute it just like I bought the ETF. That's it, I'm happy. You really need to go look at the land. Does it have power and water? Is it the corridor? Is it the right corridor to just, ship the product that you're manufacturing or the logistics? Is this a good tenant? How am I going to structure the lease? So all those things are so local. But the macro is, the theme is very macro.
Well, speaking of access to the US and the US market, tell us about how the border policies of the current administration have impacted this business or not, and as well as the drug cartels and some of the, initiatives that the US has been taking together with Claudia Sheinbaum, and where that all where you think that'll land up.
That's a very good question, and it's a question that is difficult to answer. The security issue is important. There's a lot of things changing based on the relationship between U.S. and Mexico. I do believe that Mexico is the most important trading partner for the U.S. So that relationship is not going away. I don't believe the current administration will fight with China and will fight with Mexico. I do believe that there's a bright future in the relationship between the U.S. and Mexico. As we speak, the USMCA is being renegotiated right now. I believe it's going to be a good outcome. Maybe not the perfect outcome, but definitely an outcome of regionalization where, we're going to be a bloc in the northern side. But in terms of security, it concerns me, it worries me. But I do see, I follow more what companies are doing. Companies are not getting out of Mexico. They understand well the security issues. We ran a survey into the whole border, and no one's getting involved in the industrial market. We continue to see the flows. The border is completely open for trade. You need to differentiate between the issue of immigrants and the issue of trade. So the trade continues to flow. Tijuana is open, Monterrey is open. What closes is the immigration border. We're talking of population and another problem between the US and Mexico. That's not a trade problem.
And who are the major sort of multinationals that are in these sort of Mexican markets? And who do you think are the next wave of manufacturers who may arrive there?
In terms of multinationals, you have everyone. It's quite shocking. You have Foxconn, you have DHL, you have the Amazon, you have Worry, you have companies, all of them manufacturing because labor, what drives this strategy that people think sometimes, is the USMCA or is the proximity. It's labor. Labor is the major component for someone to manufacture or to operating in one of these plants. And I would say it's more or less 30% of your cost. So if your cost is so much more cheaper than the US or China, you're going to establish yourself there. I think that's what's driving this strategy. I think that's the reason multinationals are establishing themselves there. A lot of the logistic companies, auto company, you have manufacturing plants for, a lot of the Asian companies, a lot of the German, American, they all have plants in Mexico, but it's not so much that plant, it's more the ecosystem, as I mentioned before. So now what we start to see is Tijuana becoming a hub for medical devices. So, we've seen a lot of the medical companies moving into the Tijuana region. The center of Mexico is a lot of logistics. So, a lot of the main logistic companies are there, established there. Of course, the auto industry in Puebla, the auto industry, as I mentioned, Juarez, and a lot of the manufacturing and industrial facilities established in Monterrey.
So how should investors play the current situation where you have this cyclical sort of correction? Is this a good time to be buying from over-levered developers? Is this a good time to actually start developments? Because by the time they come online, the trade agreements have been ratified. Where's the opportunity to play? And what do you think the right return profile is for industrial development that plays to nearshoring?
I think, for us, we started doing build-to-suits. So we started the strategy 2019, just executing build-to-suits because there were no projects. So, a company would say, I need this, do it as soon as possible. Here's the lease, let's sign it. And we could go to the bank, lever and build and then lease it for 10 years. We did that for almost 4 years. And then the market shifted because of tariffs and because of uncertainty. And then we started to see an opportunity to buy and to do acquisitions. So we've been buying for the last year and a half stabilized assets. And we shifted the whole thing to just buying stabilized. And where do I see now? Look, we can still go into markets to do spec because a lot of companies are looking for move-in ready product. But location is key. Because a lot of the excess demand that was built maybe was not the best location. And that's where you need to start to differentiate between the spec that was created in not so optimal locations versus now that we can really find great land and do spec in fantastic locations. So that's one strategy that I would execute. There's not so much leverage in the system. So when you do spec, you don't have leverage. And that allows developers to wait. Different from the US, that they have the gun in their head and then you can go and just buy it from them because there's a lot of leverage. What I feel is that, we've been executing on the stabilized asset side. I like it. I think it's companies more maybe feeling the pressure that they want to lighten their balance sheet, so we can do that. Sell and leasebacks, that also has been interesting. I think the market will go back to the build to suit, at some point, but we need to just make sure that all this excess inventory gets absorbed and that some of the spec that is being developed now in optimal locations also gets rented. Once we see that, I think we're going to see the curve. Just in terms of, cap rates in Mexico are historically, so I'm looking at 10 years or maybe 15 years, they're around 190 to 200 basis points above the US market. So that's the way we need to think, that cap rates, let's say in the US, and we're talking AAA markets, AAA properties, credits, So an Amazon in the US, maybe it's at a 5, maybe 4.5. In Mexico, it would trade maybe at a 6.5, maybe, at a 7. And most of the development, the build-to-suit development in Mexico was being done and continues to be done at 9 to 10%. So that's the yield on cost. There's a lot of access to leverage. That's quite incredible. And leverage has been consistent because Mexican banks have a lot of liquidity. Rates were very high in the local market in Mexico, so they couldn't, do mortgages to individuals. So they have a lot of liquidity, and the best market to go in is a dollar market that is very stable, very safe. So they've been lending, I've seen things maybe SOFR plus 200 right now, SOFR plus 225. So very similar to the US market, not very different. So if you can develop at a 9, lever at a 6, there's a good chunk of profit there. So, but again, I assume after this podcast, everyone's going to start doing their numbers and see how they do it in. But the challenge is execution. I think the challenging part is to make sure that you buy the land and you know how to buy the land, and then you know how to execute a project.
And in terms of ownership, what does the ownership profile look like? Are there U.S. institutions who own the industrial that's stabilized and fully leased, or is it Mexican institutions or high net worths? What's the investor profile?
The REIT market developed started in 2010. Now it's very deep. The capital markets are functioning very well. Most of the REITs in Mexico, the FIBRAs, are funded by the local pension fund. The pension fund system in Mexico is a mandatory system. So you're obliged to contribute to the system. So it grows very fast, just like the Australian system. And so they have a lot of liquidity. And they've been backing a lot of these REITs. And so these REITs, Prologis is the largest REIT in the country. So, and they have executed in an amazing way. It's really like a Macquarie is present with a REIT, and now it's being acquired. And so there's a lot of REITs. So for us, the strategy, we've been backed by pension funds in Europe. Now we're backed by a sovereign wealth fund from Asia. And what we're doing is just creating products, stabilizing it. And our plan is to sell it to the REIT system. We don't plan to do a REIT. We're just planning to create enough inventory, stabilize it, create very nice, Class A portfolios, trying to stay very green, to have all LEED certified properties, and just pack it and then, create a very nice portfolio where we can create a premium and sell it into the REIT market.
In terms of, the next 3 to 5 years, how do you see the market developing? What's your, personal business plan? Is it to continue doing both build-to-suits and acquiring? Would you do spec?
We'll do everything, and we'll move with the cycle. I think that the key in the end is just to understand that we're in a typical real estate cycle. So we need to shift our strategy into that cycle. And that's the reason when we could do build-to-suits, we were executing on that. Now we're in a different part of the cycle. We need to, we've been doing stabilized, sell and leasebacks. And then the next phase, I believe we're going to start doing some spec, because we want to be ready when the USMCA gets ratified again, or, when it gets renegotiated and we have clarity and companies have clarity on policy and tariffs. That's when it's going to be interesting, because the pipeline is there. We have tons of LOIs out there and companies waiting to come in. But the way they're being coming in is they're like, give me 100,000 square feet or give me 200,000 square feet, when their plan is 1 million. So we see these companies and, we're leasing the 100,000. But they say, but just save me those 900,000 when we get some clarity. So I believe that market, it's a typical real estate cycle. So again, I'm going to repeat it again. Nearshoring is structural. The strategy is cyclical, and the real estate market is cyclical.
Let's double click into the return profile of what you're doing. Can you walk us through in a little more detail the returns that you generally generate on your build-to-suit developments, from overall levered returns to the cash on cash along the way?
A lot of these investments are in primary markets. So when we think between the US and Mexico, I'm going to try to compare it to the US, but this is really Class A, primary market, multinational, investment grade, guaranteed from the mother So we're really getting corporate guarantees. So let's think about apples to apples. For us to do a build to suit would be at a yield on cost, as I mentioned before, of 9 to 10%. So the way it would work is we would sign a lease with that multinational, and then we can go to the bank and we can get around 70% loan to cost. So the equity will really go into the land. Then we will get leverage in terms of the cost. And it would take us around 8 to 12 months to develop one property. So once we get the property and we deliver, then we would, get it at a leverage. We could, just switch that loan to permanent, the construction to permanent, and get a rate of SOFR plus around 200 to 220. Leverage would be around 60% to 65% loan to value. We would generate a low teens cash on cash, yield. That's an amazing asset in dollars. And then if we're assuming an exit cap rate, so we're generating a cap rate of 9, and, when I say yield on cost, and an exit cap rate, our underwritings are at 8%, that I think it's very conservative. But thinking of a 7.5 or 7, where we see them trading right now, we've seen asset trades at 7%. We're generating a high teens return, maybe 20. So, I think it's a very compelling strategy. Of course, a lot of the, kind of global capital finds it challenging to go because it's Mexico. And Mexico is not at the top of the list in anyone's investment strategy, when you think of the US and Europe. So, but I think the returns are definitely compelling.
And just to clarify, your leases are in dollars. I presume your debt is dollar-denominated as well. And so the only thing that's not dollar-denominated are your construction costs, in essence.
Correct. Exactly. So that's what makes it, very attractive for global capital, because a lot of the global investors, when they think of going into emerging markets, they always think of currency risk or, kind of rule of law risk, or how do, I get in, get out, or how do I understand the dynamics of a local market? But this is, as I mentioned before, this is, a U.S. strategy domiciled in Mexico.
And just in terms of thinking about the future, any concerns about automation, robotics, sort of changing the cost dynamic between Mexico and the US? And then how do you think about autonomous vehicles? Is that going to speed up delivery and, increase the viability of the Mexican markets for the US?
I think, all the sophistication is going to continue to happen. AI, robotics, automation. But I think that's going to happen first in the US. And it's happening in the US as we speak. But then there's always going to be something, kind of the low skill level manufacturing that is needed, the logistics that needs to be handled. I think that's always going to exist. So, Mexico will continue to be the manufacturing logistic hub because it's cheaper to have it there than to have it in the US. So a lot of the sophisticated manufacturing and very high-end, technology-wise, it's going to happen in the south side of the U.S. And then the things that are low skill, it's going to ripple down to the border, to the south border, and it continue to add value to that process. So I think, my big bet on this is that, and I will recommend a book at the end of the podcast, but the big bet is that the regionalization is going to continue to happen. Globalization was real, and the nearshoring strategy is a result of globalization. But now we're entering a new cycle of regionalization. What that means is, and you see Asia becoming a region, Europe becoming another region, and the US, once we get clarity and this administration finds peace with Canada and Mexico and the US understand each other, I think we're going to get Latin America and the US will be integrated into one region. And that's going to be the most powerful region because of the US, more than Europe and more than Asia. That's my big bet. And if that's true, nearshoring will become more important. And the macro theme is going to play so strong that the execution of what we're doing, and my bet to the future is that 200 basis point spread between cap rates in the US and Mexico should definitely, contract. And my hope is going to be 100 because the credit is going to be the same. The same credit you have in North Carolina, it's going to be based in Mexico. So how are you going to trade those credits so different when, some of these are primary markets and in the US are secondary markets? So it's going to be super interesting how this plays out.
Gregorio, before we wrap up, I always like to ask, do you have any recommendations for the audience unrelated to real estate, whether that's a book, a philosophy, a work of art, a form of exercise?
I think in terms of books, and very relevant to our conversation is the Globalization myth from Shannon O'Neill that really explains how globalization became regional and how regions are going to be important in the future in terms of how we see it right now happening. And it's happening so fast where we see Asia becoming a block, Europe becoming another block, and how the US together with Mexico and Latin America will become a very, very powerful, if not the most powerful regional bloc in the world. So I expect that to happen. And I think Shannon O'Neill builds a fantastic case for that. In terms of personal, I think, life is just like a real estate cycle. You definitely expand and contract and then you transition. So that's the way I see exactly life, just like markets. And I think that's where the running, hiking, and yoga happen. So, but thank you very much, Raphael.
Well, thank you. I look forward to reading that book. And it sounds like it's a good counter to, Thomas Friedman's The Earth is Flat. And seems like the world is changing and we're recognizing that it's a sphere and it's not flat. So Gregorio, thank you so much for joining us today. For those interested, Gregorio's paper, The Southern Border and the Nearshoring Debate, is available on the Paul Milstein Center for Real Estate at Columbia Business School's website.
Thank you, Raphael.
Thank you for listening to the Real Estate Forum, a podcast brought to you by the Paul Milstein Center for Real Estate at Columbia Business School. Be sure to subscribe for more insights from real estate thought leaders, industry professionals, faculty, and the latest research and expertise from the Milstein Center's Research Lab at Columbia Business School. If you've enjoyed the episode, please follow, rate, and share the podcast. You can keep up to date with the Paul Milstein Center for Real Estate at business.columbia.edu/real estate. Thanks again for joining us, and we will see you next time.